A quiet, systemic change occurred inside the American banking system this week. If you attempted to purchase a silver coin, a gold bar, or a cryptocurrency with your debit card and the transaction was declined, you did not experience a random error. You witnessed a coordinated policy shift. Major financial institutions have begun to systematically block transactions tied to specific merchant category codes, the digital fingerprints for precious metals dealers and crypto exchanges. This is not a story about fraud protection. This is a story about control. It is about the visible signs of a hidden market imbalance so severe that the institutions built to facilitate commerce are now actively constricting it. The narrative you are about to hear connects digital error messages to vault inventories, to central bank balance sheets, and to a global geopolitical realignment. This is a forensic examination of a fracture in the financial system, told through data, precedent, and the logical inferences that emerge when the official story no longer matches the facts on the ground. The official action, the one communicated to confused customers, is framed as a protective measure. Banks cite enhanced fraud monitoring, protecting customers from volatile commodities, or high-risk merchant categories. This language is carefully chosen. It is paternalistic. It positions the institution as a guardian, stepping in to prevent the individual from making a poor or risky decision. This official story matters because it is the public-facing justification for a profound restriction. Its purpose is to defuse alarm, to frame the blockade as a service, not a constraint. It aims to prevent the natural question, if this is for my protection, why am I not allowed to choose? By using the language of security and risk, the banks attempt to bypass that debate entirely. The importance of this official narrative cannot be overstated. It is the buffer between a technical banking policy and a public perception of capital controls. If people believed their access to asset classes was being politically or systematically restricted, the reaction would be immediate and potentially destabilizing. Therefore, the story must be about safety, about the bank's diligent algorithms working overtime to guard against scams and market volatility. This narrative allows the action to proceed under a cloak of normalcy. It transforms what could be seen as a defensive, systemic maneuver into a routine, customer-centric security update. The calm, automated message, transaction not authorized, belies the significant, deliberate reconfiguration happening in the background. This official explanation is the first layer of the story, the surface presentation designed to be accepted and dismissed. But its very existence, its sudden and uniform application across multiple institutions, signals that the events it claims to prevent, fraud, loss, are less important than the event it is actually causing, the restriction of flow. The story of protection is, itself, a data point. It tells us that the institutions perceive a threat large enough to justify a blanket restriction, and that they are deeply concerned about the public understanding the true nature of that threat. To comprehend why this blockage is happening, we must examine the stark and growing divergence between the paper market and the physical market. These are two parallel worlds describing the same asset. The paper market is one of digits, derivatives, and futures contracts. It is the world of the COMEX, where silver is traded in massive electronic volumes. Here, price is set by the interplay of leveraged bets, algorithmic trading, and the perpetual rolling of contracts. In this realm, supply appears infinite because it is a promise to deliver metal at a future date. The critical metric is open interest, the total number of outstanding contracts. As of recent data, the open interest for silver futures represents a claim on hundreds of millions more ounces of metal than actually exist in the exchange's registered deliverable vaults. This is not necessarily nefarious, it is the mechanics of a fractional reserve paper system. It functions smoothly as long as only a tiny fraction of contract holders ever demand actual physical delivery. The price discovered in this paper world is broadcast globally as the spot price, the official benchmark. The physical market is a different universe. It is the world of minting presses, of armored trucks, of dealer safes, and of industrial fabrication. Here, supply is starkly finite. It is limited by mine output, refining capacity, and the logistical reality of moving heavy, tangible metal. Demand in this world comes from manufacturers needing silver for solar panels, from jewelers, from technology firms, and from individuals who want a coin or a bar they can hold. The key metric here is premium, the amount over the paper spot price you must pay to take immediate possession. This premium is the true price of physical metal, and it is dictated by simple availability. Recently, this premium has been rising sharply. For popular items like American Silver Eagles, the premium has moved from a few dollars over spot to several dollars over spot. This is the first signal of strain. A widening premium is the physical market's way of saying it disagrees with the paper price. It indicates that at the paper price, demand for the tangible item outstrips immediately available supply. The two markets are connected, but they are not the same. The paper market is a pricing mechanism of promises. The physical market is a delivery mechanism of reality. For years, they have coexisted in an uneasy tension. But when stress enters the system, be it financial panic, geopolitical uncertainty, or a loss of faith in currencies, the disconnect can become a chasm. Individuals, sensing instability, instinctively seek the tangible. They move from the world of paper promises to the world of physical possession. This movement is called taking delivery, and it is the mechanism that forces the two worlds to reconcile. If too many participants in the paper market decide to become participants in the physical market, the system faces a simple mathematical problem. There are not enough physical ounces to satisfy all the paper claims. The blockage of debit card purchases at the retail level is a direct intervention at this exact junction. It is an attempt to slow the migration from the digital, paper-based financial system, your bank account, into the tangible, physical asset, silver or gold. The banks are not merely blocking a transaction. They are attempting to reinforce the wall between these two diverging markets. The reality of the physical shortage is not a matter of speculation. It is revealed in vault data, inventory reports, and supply-side metrics. The COMEX publishes weekly inventory statistics, dividing silver into two categories: registered and eligible. Registered metal is warehoused and available to back futures contract deliveries. Eligible metal is also stored but is not pledged for delivery. It could be held by an ETF, a bank's proprietary stock, or a long-term investor. The registered category is the crucial buffer for the paper market. Its recent trend has been a persistent decline. From levels that once seemed comfortable, the registered stock has been drawn down, sometimes precipitously. Each ounce that leaves the registered category represents a paper contract that has been settled not with cash, but with metal. This is a physical claim being honored. When the registered stock falls, it increases the cover ratio, the amount of paper claims per ounce of available metal. This ratio becomes a measure of systemic stress. A high ratio means the paper market is built on an increasingly narrow foundation of actual metal. Beyond exchange vaults, the supply chain data tells a congruent story. Major mints, like the US Mint, periodically announce production limitations or allocation programs for their bullion coins. They cite shortages of silver blanks, the raw, pre-struck discs from private refiners. These refiners in turn report backlogs. They cannot acquire enough raw material, often in the form of recycled silver or mined concentrate, to feed their presses fast enough. This bottleneck manifests as extended delivery times. A dealer who once could fill an order from warehouse stock may now quote a lead time of several weeks. This is not a demand problem. It is a supply chain problem. The industrial demand side adds relentless pressure. Silver is a critical industrial metal with unique properties for conductivity and reflectivity. Its largest and fastest growing demand segment is in photovoltaic cells for solar panels. Global solar installation targets are aggressive, and each new panel consumes a fixed amount of silver. This demand is inelastic. It is not highly sensitive to price in the short term, as it is driven by government mandates and long-term energy projects. This industrial demand acts as a constant, underlying drain on above-ground stockpiles. It consumes metal that is effectively removed from the investment pool for decades. When you combine a shrinking buffer of deliverable metal on exchanges, production bottlenecks at mints and refiners, and a relentless inelastic industrial offtake, the picture is one of a market in a structural deficit. The data suggests that for several years running, annual consumption of silver has exceeded annual supply from mines and recycling. The difference is made up by drawing down above-ground inventories. These inventories are not infinite. The recent banking actions to block retail purchases can be seen as a response to this data. The institutions see the same inventory reports, the same mint announcements, the same industrial forecasts. They recognize that a surge in investment demand, triggered by broader financial fears, could overwhelm this already tight physical system by restricting the easiest on-ramp for retail investment, the debit card purchase. They are attempting to modulate that demand. They are trying to prevent a stampede into a theater that, according to the supply-side data, does not have enough seats. The motives of the banks and financial institutions enacting these blocks must be examined from a neutral operational standpoint. Their primary mandate is not to facilitate your personal asset allocation. It is to ensure their own solvency, liquidity, and regulatory compliance. From this perspective, their actions are a rational, if severe, risk management response. Banks operate on a fractional reserve system. The money in your checking account is largely not sitting in a vault. It is loaned out to other customers, invested in securities, or used to meet the bank's own operational needs. When you use your debit card to buy an asset outside the banking system, like physical silver held at a dealer or Bitcoin on an exchange, you are initiating an electronic transfer that permanently removes those funds from the bank's balance sheet. The bank must settle that transaction with real cash. In normal times, this is a trivial, daily occurrence. However, in times of perceived systemic stress, banks become acutely focused on liquidity, their ability to meet all such withdrawal demands. A sudden, coordinated movement of deposits out of banks and into alternative assets would constitute a liquidity drain. It would force banks to sell other assets, potentially at a loss, to raise cash. This is precisely what triggered the collapse of Silicon Valley Bank in 2023. Depositors withdrew en masse, and the bank was forced to sell its bond portfolio at a steep loss, eroding its capital. The current block on certain MCC codes can be interpreted as a preemptive defense against this scenario. The banks are observing signals, the rapid draining of the Federal Reserve's Reverse Repo facility, which indicates large pools of institutional cash leaving a safe haven, rising demand for physical bullion, and volatility in cryptocurrency markets. They are connecting these dots and perceiving a potential for a correlated rush towards exit doors. Their motive is to slow that rush, to maintain control over their deposit base, and to avoid being forced into distressed asset sales. Furthermore, there are regulatory and compliance dimensions. Banks are subject to stringent know your customer and anti-money laundering rules. Precious metals and cryptocurrencies have historically been viewed by regulators as higher risk channels for illicit activity. By tightening controls on these merchant categories, banks may also be seeking to insulate themselves from regulatory scrutiny or potential fines. They are simplifying their risk landscape by simply severing the connection to certain asset classes. This is not a conspiracy in a shadowy room. It is the cold, system-wide application of risk aversion protocols. The synchronization across multiple banks likely stems from shared risk models, common regulatory guidance, or the use of the same third-party fraud detection services that have updated their parameters. The motive is systemic preservation. The individual customer's desire to buy a silver coin is collateral damage in a larger calculation about balance sheet integrity and systemic liquidity. The banks are not necessarily acting against the customer. They are acting for the preservation of the banking entity itself, as defined by its algorithms and risk committees. In their calculus, the reputational damage from declining transactions is less severe than the existential risk posed by a potential liquidity crisis. The experience of the retail investor, the individual at the other end of the declined transaction, is one of confusion, frustration, and a dawning sense of distrust. This psychology is critical to understand. For years, the implicit social contract has been that your money in the bank is yours to spend within legal bounds as you see fit. The sudden, unexplained interference with a specific category of purchase, especially one tied to financial security and historical safe havens, feels like a violation of that contract. The initial reaction is often to troubleshoot a technical problem. You check your balance, you call customer service, you are met with a scripted response about security and risk. For a financially savvy individual, this rings hollow. They know the difference between a fraudulent charge and a deliberate purchase from a reputable dealer. The explanation feels like an insult, a patently false cover story. This leads to the second stage, suspicion. If the official reason is not credible, what is the real reason? The individual goes online, finds communities discussing the same issue, and a narrative begins to form. The isolated incident becomes part of a pattern. The psychology shifts from "my card has a problem" to "the system is preventing this action." This is a profound psychological shift. It moves the locus of control from a personal technical fault to a systemic, intentional barrier. This breeds distrust, not just in a single bank, but in the architecture of the financial system itself. If you cannot freely convert your digital bank credits into the asset of your choice, how free is that money truly? This questioning is deeply unsettling. It contradicts the advertised promise of a free market. For some, it triggers a defensive response, a determination to find a way around the barrier, to use cash, to seek peer-to-peer transactions, to become more self-reliant. For others, it creates anxiety and paralysis. The empathetic view recognizes that this is not merely about investing. For many, buying physical silver or a small amount of Bitcoin is an act of prudence, a modest hedge against uncertainty, a tangible form of savings outside the digital banking matrix. To have that act blocked by the very institution that holds their savings creates a cognitive and emotional dissonance. It feels punitive, it feels controlling. And most of all, it feels like a warning, a signal that the institutions perceive a danger that they are not articulating to the public. This psychology of awakened distrust is perhaps the most significant unintended consequence of the banking policy. By attempting to manage systemic risk through transaction blocks, the banks risk accelerating the very loss of confidence they fear, pushing more people to seek exits before those exits are fully sealed. Given the established facts, the coordinated action, the paper-physical disconnect, the tight supply data, the institutional motives of liquidity preservation, and the resulting public psychology, we can consider potential scenarios without prescribing action. One scenario is containment. The transaction blocks, combined with other measures, succeed in slowing retail demand. Institutional flows are managed through off-market channels. The physical shortage is rationed through high premiums and long wait times, but a catastrophic price spike in the paper market is avoided. The disconnect between paper and physical prices becomes a permanent accepted feature of the market with two different pricing tiers. The system adapts to a new normal, where accessing physical metal is deliberately more difficult and expensive. Another scenario is escalation. The blocking of conventional payment rails drives demand into alternative channels. Peer-to-peer cash transactions surge. Decentralized cryptocurrency transactions increase as people use crypto to indirectly access precious metals or simply hold it as a parallel asset. The policy backfires, demonstrating the impossibility of completely controlling the flow of value in a digital age and accelerating the adoption of the alternatives it sought to marginalize. A third scenario is a catalyst event. The physical supply strain becomes impossible to ignore. A major institution or a sovereign wealth fund makes a public, large-scale demand for delivery that cannot be met by the existing paper system. This triggers a contractual crisis on the COMEX or similar exchange, forcing a reckoning. The paper price is forced to surge violently to attract metal into deliverable position, or trading rules are abruptly changed to settle in cash. Such an event would be a watershed, publicly validating the physical shortage and likely triggering a global repricing. In this scenario, the banking blocks would be seen in hindsight as a failed early warning sign. A final scenario involves geopolitical alignment. The movement away from dollar-centric trade, hinted at by BRICS nations discussing commodity-backed settlement, continues. If significant global trade begins to bypass the dollar and the Western banking messaging system, the demand for the precious metals likely to underpin new settlement mechanisms would be institutional and vast, coming from central banks themselves. This demand would dwarf retail investment flows and render retail banking blocks largely irrelevant to the core price dynamic. The price would be set in Shanghai or elsewhere, and Western investors would simply have to pay it. Each of these scenarios unfolds from the same set of conditions we see today. They are not predictions, but logical pathways. The common thread is tension, the tension between finite physical reality and infinite paper claims, between individual agency and systemic control, between established financial order and emerging alternatives. The declined card is not merely a declined card, it is a point of friction where these immense tensions become personal, tangible, and real. It is a signal in the noise indicating that the hidden imbalances within the system have grown large enough to trigger visible defensive reflexes from its most central institutions. The story is no longer about why you cannot buy a silver coin. The story is about why the system feels it must stop you.